Welcome to the video Trading for Beginners. Now, the goal of this video is to provide you with a full step-by-step process on where you want to get started and how do you get to consistently profitable trader. Now, even if you're an intermediate trader watching this, you may have experience for a couple of months already. Watch this video because I'm gonna lay out all the steps that you will need to build upon your existing strategy and to improve further. And for those of you guys who are just getting your feet wet, into the trading world, this is gonna be perfect for you because I'm gonna dive into the fundamentals, what you're expecting from the markets, the technicality, the strategy, the system, everything. By the end of this video, the goal is to make sure you have a complete system, not a strategy, a complete system to approach the markets long-term profitably. So some of you guys may have known who I am. I am Lucas and I am part of the Urban Forex trading group, and I've been around for quite some time. I've personally been in the markets for almost a decade, and I've been part of Urban Forex for the last 8 years. So throughout the years, I have dabbled in the markets. By dabble, I mean, day trading in the markets. I have gone into investing with what I've learned. I have also been a mentor at Urban Forex. So I have different perspective, both as a trader as well as a mentor, understanding what are the struggles people are usually struggling with. So I want to take what I have learned from Urban Forex, from Naveen, our founder, and show you the exact steps on how to get consistently profitable from day one. So let's get right into it. There's going to be 5 main topics that we're going to be covering in this video. First one being setting the right expectations. Second one being the technicalities. Third one being getting started, which we're going to dive into the strategy. Fourth one, bookkeeping, treating it like a business. Fifth one, the end goal. By the end of this video, you should have a full-blown system on how you want to approach the markets. So let's first start off with the expectations. Everyone coming into the market, especially new traders coming into the market, they generally have these 3 things they are wondering. Number 1, how much can I make from the markets? Number 2, how much capital should I start trading with? Number 3, how long can I get to consistently profitable? So let's start off with the first one. How much money can you make with trading? Now, trading is just like any other business. You can have a restaurant that's making, $1,000 in revenue per month. You can have a premium restaurant that's making $10 million revenue a month. Restaurant A and Restaurant B, they're both restaurants and they're both making money. But the difference is, this is a very low-end restaurant, but this is a very high-end restaurant, right? If we think about trading, it's the same thing. You could have 2 traders. One trader could be making consistently $1,000 profit a month. Another trader could be making $100,000 a month consistently. To really answer this question, let's look at some scenarios. Now, as we're looking into this example, it's very beneficial that we also think about how much money do we need to start with. Okay, so let me give you an example. Let's say we have a $10,000 capital, right? This is your trading capital. This is what's inside your broker. All of that I'm going to cover in a bit, but I want to set some scenarios here first so we can set the right expectations. Now, let's say as a trader, you are able to make 10% per month consistently. Okay, so with a $10,000 capital, you're able to make 10% per month. Let's say 10% per month. What's 10% of 10,000? That's $1,000 per month. Okay, obviously, this would change depending on your strategy, which is something I'm going to cover in a bit. And obviously, this would also be different from trader to trader. For some people, $10,000 is a small amount. For others, it's a big amount. Okay, but there are ways to get around this if you have a small account. So from the very, very beginning, this is not something you want to be thinking. Let's look at another example. Let's say you have a $5,000 account. Okay, every month you are able to make consistently, let's do this the right way, 20% per month. Okay, and what's 20% of 5,000? That's still 1,000, right? So you can see Even though the starting capital is different, but if you're able to make more in that month, you're able to make just as much as trader A, right? So we can do a lot of other simulations. I would suggest coming up with your own simulation, but when you're starting off, don't aim for 100% per month. That's just not viable, right? Don't aim for 200% a month, 100% a month. Just start with a small goal and then experiment. I'm gonna cover more of that later on. I probably sound like a broken record now saying that so many times, but I'm gonna show you what all of that will look like on a chart so you can visualize how it would look like. So, which leads me to the second point. How much money do you need to begin with? At the very beginning, you are not supposed to commit any capital to your trading until you see you have the skills to trade the capital, okay? But let's say you're watching this video and you already have some sort of idea of where your skill level is at. I would suggest starting small, 5,000. Again, 5,000 could be small for someone, 5,000 could be a lot for someone. Start with something manageable, small, where if you lose that money, it's totally fine. As you see that you are growing, then we can slowly scale up the capital. So there's no real one answer to this. So it all comes down to a few things. How much capital do you have to begin with? And what's your trading performance? What's your monthly return? Knowing these two, that's where you are able to answer the number you need. So the first one, the trading capital, that's not something this video can really help you with. Okay? Trading capital is something that you have to personally be able to finance your own trading. But what this video is going to be able to help you with is learning the right strategy and getting your monthly percentage return higher. Now, the third one, let's say everything is well, right? You have enough capital and you're good at trading. Next question is, how long does it take to be a good trader? Now, again, I have been in this industry for almost a decade now. So I can tell you I have seen traders being profitable in the first year of their trading. I have seen traders being profitable after the 7th year of their trading. So unfortunately, again, I can't give you a clear answer to that. But what I'm able to tell you is this. If you are able to commit 1 hour a day, 5 days a week for 6 months, you will be able to see progress. Doesn't matter if that progress is in understanding charts or progress in returns from your trading capital. But hopefully with this video, you will be able to get there faster because everything that I'm going to show you here is derived from Urban Forex. If you want to get there faster, I suggest picking up the course at urbanforex.com. Now, again, trading is really just like any other business. You don't want to set yourself up for failure just because you have a very high expectations. Think about people studying to become a doctor, a surgeon, a heart surgeon, right? They take 7 years, 10 years of their life, not making any money. And then on the 11th year, when they're going into the operations room, that's where they start, putting their skills into action, and that's where the big bucks come in. Trading has an opportunity for making those big bucks. So just thinking logically, we're not able to make those huge bucks in the first 6 months, in the first, 3 months of trading, right? Things take time, but with time, you will get better. So what I would suggest is focusing on the end goal, but be very aggressive with learning and progressing. Now that you have an understanding of the expectations, don't worry though, after this video and after you have completed a series of trades, you would be able to set the right expectations for yourself. And you will be able to come up with your number and understanding how to get to your goals. But before that, let's head up to the charts and let's now understand the technicality. What are we actually doing in the market and how do we actually fit in? So let's head on to the charts. Alright, so before you start trading, you need to understand what's actually happening behind the scenes. Imagine you're at an auction. Buyers and sellers are constantly negotiating price. That's essentially what's happening in the financial markets. It's a global marketplace where people are just constantly buying or selling currencies, stocks, commodities, or even cryptocurrencies. Now, here you can see I have a chart of Euro USD, and what this actually means is this is the strength or weakness of these two currencies side by side. Now, in a more layman's term, if we look at Euro USD, and if we look all the way towards the right here, it is 1.075. So that means you would need 1.075 US dollar to buy 1 euro. So it's the exact same thing as what you will see on the currency exchange shop. Okay, but what we're looking at here is at a bigger scale. We're looking at every small change would mean a huge move in the markets. And the Forex market in particular is massive, right? It's the largest financial market in the world. Over $7 trillion are traded every single day. Unlike the stock market where trades happen on a centralized exchange like the New York Stock Exchange, Forex trading happens over the counter. Okay, basically means it's decentralized, and again in layman terms it means no single entity controls it. It's just big networks of banks, institutions, retail traders like me and you, so on and so forth, right? So what determines if Euro USD is going down? It might be things tied to the European economy, or it might be things tied to the dollar economy. These stuff are not stuff that you really want to dive deep into as you first start trading. Okay, but this is a rough understanding you need to know in order to understand what Euro USD is. And here we have a stock chart, right? This is Tesla. Hopefully you know what Tesla is. And if you see price going up, that just means the company is doing good. Price is going down, it might mean that company might be doing bad. Again, that's in the most simplistic format that I can explain it to you, just so you have an understanding of how it differentiates with the Forex market. And then here we have Bitcoin. Now, Bitcoin is solely based on supply and demand. I'm not gonna get into the full fundamentals of what Bitcoin is, but it's solely based on how much supply is in Bitcoin and how much demand is in Bitcoin, right? It's solely based on supply and demand. However, they all might have different nature in how the market are built up. But in terms of how Urban Forex reads it, it's the exact same way across all markets, which is what we're going to be covering on the strategy part. Okay, let's move on to the second point. Where do you fit in as a trader? So let's break it down, right? There's three main tiers. At the very, very top, we have the big players. Players like central banks, hedge funds, financial institutions. These guys, they trade millions, sometimes even billions of dollars at a time. And they move the market. They have teams of analysts, access to deep liquidity, and high-speed trading algorithms. These, if you're familiar, is what we call the big boys, okay? One tier below that, we have the professional traders, right? These are fund managers and prop traders who trade for big companies or high net worth individuals. They have years of experience, strict risk management, and a clear trading edge. One more tier below that, we have the retail traders, right? That's you and me. We trade smaller amounts and we don't move the markets like the institutions do. But here's the catch, we don't need to. Our goal is to ride the waves created by the big players, not fight against them. Think of it like you're surfing, right? You're not there, you're not in the ocean to go against the wave, but you're trying to get along with the wave to ride the wave. Does that make sense? This is a fundamental topic that at Urban Forex, we hammer into our traders a lot, that whatever we do in the market, we are all just following the big boys. We're not there to go against them. We'll cover this very, very shortly. Okay, third point. Where does your money actually go? When you place a trade, what actually happens behind the scene? Where does your money actually go? Does it go to a leprechaun and then they take the money, and then when the rainbow appears again, then they give you money? How does it actually work? So let's break it down. When you place a trade, your money actually goes to a broker. We all need a broker to place a trade, so it's nothing sketchy. So your broker is the middleman between you and the actual market. But not all brokers operate the same way. Some brokers, they act as market makers, meaning they create their own financial mini market and take the other side of your trade. So if you buy, they would sell. If you sell, they would buy. Now, this doesn't necessarily mean they're scamming you, but it does mean that there is a potential conflict of risk. Again, does not mean they're scamming you. This is just how some brokers are set up. We call them B-book traders, right? So when there's a B-book traders, you'll know there's gonna be an A-book traders. And what is A-book traders? They connect you directly to the liquidity providers. Okay, I'm putting out a lot of new terms now, but liquidity providers, it just means that you are actually trading against other traders in the market. Okay, so think of it where your money actually goes into the market. Many beginners, even intermediate traders, they don't even know how they're trading. They don't even know who they're trading against. They assume every time they click the buy or sell button, that trade goes straight into the market, but that's not always the case. This is why choosing the right broker is crucial. So now you understand how the market works, where you fit in, and where your money actually goes when you trade. This knowledge alone puts you ahead of 90% of the beginners who are just opening a trading app and starting to press button without knowing what's happening behind the scenes. Okay, so now that we got the basics covered, let's jump into the most juicy part, the actual strategy. Now, in order for you to test out strategies and to start actually trading and learning strategies, what I would recommend is doing a short research on the brokers out there and find a broker that is regulated in your country, okay? Now, I'm not allowed to give any financial advice in this video, but you want to be very careful not to fall victim to any of these brokers. However, because you're just starting out, I highly not recommend committing any capital to the broker you're starting out with. I just want you to start off with a demo account. Now, in most brokers, actually in all brokers, they offer a demo account. Now, what a demo account means is you're able to put in fake money and just test out your strategy. This is almost like your training gym before taking your sword, your axe, your weapon to the battleground. So demo account is the perfect place for this, at least for the first 3 months of your trading. Or even if you're an intermediate trader and you want to test out a new strategy or a new approach, or if you find that you're not profitable yet, use a demo account to train and master your strategy. So after you have finished watching this video, your very first step is to look out for a broker that you can first open a demo account with and start testing out your strategies. So let's get into the third phase, getting started. All right, so what I'm using here is a charting platform. This is where you can look at the markets and potentially open trades, all right? Link in the description if you want direct access to TradingView. We have all the good stuff, so just check out the link in the video below. On TradingView, you would also have a couple of options for the brokers that they offer or the brokers that they work with. So these are all the brokers they have. For this video, I'm just gonna show you how you can start trading on a demo account with TradingView. Okay, so it says here paper trading, which is more or less the same thing as a demo account. So let me just open this up. Let me connect. Okay, so you can see here, this is a demo account I have previously opened. It's set to 87,000. You can set this to any amount you want. So again, this is your trading account, this is your gym. This is where you do all your experimental trades and start learning strategies, all right? So once you have gotten that out of the way, setting up a demo account, this is what I want you to do. Start off with this thing called the wild horse approach. Now, what the wild horse approach is, you want to start just taking trades as you see fit, without any strategy in mind, without understanding the markets at all. Whatever you see that's moving, and if you think that things are turning around or you think that things are going up, just hit buy, just hit sell. I want you to do this for at least 2 days. The reason why this is called the wild horse approach is I want you to get all the excitement out of your system and dump it all in onto the markets. Once all the excitement has died down, then you want to start learning the intricacy of why market moves the way it does and how you're able to capitalize on them. So let's just take a dummy trade right now. Okay, things are going up, so let's look for a buy here. Now, this is where things get interesting. Okay, so what you can do here is say we're looking for a buy. Okay, we're going to be buying at market and we're going to be risking 2% of our account. I'm going to get back to this in a bit, but let's put our stop loss and take profit in place. Okay, so right now, as you can see, the price is hovering around 0520, right? Somewhere around that. So let's just say our take profit is 52.50, right? So let's just put this at 52.50, 52.50. And let's say our stop loss, let's put it at, for sake of example, let's put it at 51. Okay, so once I've done that, let's go back to here and let's put 2. Okay, now order goes in. Okay, so what you would see here is this is where I have taken the buy, right? Now if price were to go all the way down here, this is how much I would have lost or how much I will lose. And if price goes all the way up here, this is how much I will gain. This is what we call risk to reward. How much money are you risking to make how much more money? Okay. If you're on TradingView and if you have a premium plan, this is something you can do very easily. Otherwise, there's this app called Stinu, where it's a position size calculator. Now, this position size calculator helps you calculate how much money you want to risk in the market and precisely where your stops should be. Now, Stinu would be able to help you calculate the exact size that you will need to get into the market based on how much you're trying to risk. Okay, so you will see that this is the amount of size that we have put into the market, and this translates to 2% of the account. Okay, I'm going off a tangent here, explaining to you, what you're risking. Okay, so that's the bare basics of what you want to understand in the market, right? When you're taking a trade, there's a few things you want to consider. How much you're going to make and how much you're willing to lose. I bet a question that you have in mind right now is, why do I have this in place? Why not just move this further? If I move this further, I'm not going to lose any money, am I? That's not the right way to think. Because as price continues to go down, if at this stage, it's 2% of your account, at this stage, it might be 10, 20, 50% of your account. You do not want one trade to wipe out 50% of your account. Okay, that's risk management. We'll come back to that later. But to start off, you always want to be risking between 1 to 3% of your account. Again, when you're starting off, that's the best thing to do. Okay, so I have gone into a tangent explaining a bit of risk management and how to set up a trade if you're just starting out. So it's very, very simple. And we're only going to be doing this on a paper trading account when we are starting off. Okay, so we are not really committing to any real money. All right, so back to the wild horse approach. For the next 2 days, I want you to just look at the markets and whatever you feel that the market is doing and you feel that it's going to go up, just hit buy. If it's going down, just hit sell. As you get that excitement out of your body, we'll slowly get the horse back into the barn and then make sure that it's in place and it's calm. Right now, let the horse run wild. Okay, let me just close out this trade and let's move on to the next section. And the next section is finding the right strategy. Now, on YouTube, on ChatGPT, on Google, if you just type the word Forex strategy, you will see a lot of strategy out there. And there's no way where you can test them all in a lifetime. But since you're watching this video, I'm gonna give you the strategy that works best for me that came from Urban Forex. Remember what we were speaking about in the earlier section, talking about riding the big boys? So that's what Urban Forex does the best. We're not coming out with we're not using any advanced trading algorithms, not using AI to trade the markets. We're just identifying where the big boy is, and then we're just riding the wave with them. In a more layman's term, that's called trend trading, okay? And in my 10 years of experience in the market, trend trading is the best way to approach because you can not just apply this in trading, you can also apply this in investment, which I have done a lot for myself on that side of things. So trend trading is very, very beneficial. Doesn't matter if you're a short-term trader, long-term trader, or you just want to take this approach to investments. Okay, so let's look at some examples of how we can trend trade. All right, so when you're looking at the market, okay, the easiest way to identify where the big player is to understand if the market is trending. And when we are talking about trending, it means it's either moving up or it's moving down. Okay, let's go back to this for a second. There's euro and there's US dollar. All right, if we're going up, it means the euro is very, very strong against the dollar. Okay, if we're going down, it basically means the euro is very weak against the dollar. You want to find situations in the market where it's either very strong or very weak. Because when it's strong, remember, who is able to move the markets? It's not people like you and me. It's the very, very big boys, the institutions, the banks, the governments. Those are the people who are able to move the markets. And when they are moving, we want to join in. Okay, so let me break it down to you. There's three main states in the market. In any markets, there's three main states. We have the range state, which is where markets just going sideways. There's the big boys are not really interested in getting it to go strong or weak. Think of it where the big boys are just not there. Okay, there is a channel state. Channel state is a range but tilted 45 degrees, right? It's getting a little bit stronger, but the big boys are not really there. And then there's the trend state. Trend state is where things are just going up and up and up, or it's going down, down, down. Okay. When we are trading in the markets, the one thing that we're always looking for is if it's trending. If it's trending, it's more easier to trade than other market states. Okay. So let's look at Euro USD. Now, if we look at Euro USD here, I want you to first start off by looking from all the way towards the left and end up all the way here. Look at where price is when it first started and look at where price is right now. If you see that overall we're going up like this, it means we are trending up. In a more professional term, we call this a bullish market, all right? So in a bullish market, the only thing you want to be thinking of is buying, getting in on a trade, okay? Joining the big boys. Next question. How do we join these big boys? If you remember how I drew the three market states earlier, you will see something like this, right? We do not want to buy as things are going up. As crazy as that sounds against what I was just speaking of, but overall, we want to make sure that when we are buying, things continue to go up. Because overall, it might be going up, but if you buy here, that's not a good proposition because the way that trader makes money is if we buy at this price, it needs to go up to this price for us to make this difference, right? If we buy at this price, but it goes down here, remember the trade that we put on earlier? If it goes down here, we're not gonna make money. We're gonna lose money. So when we are in the market, we wanna make sure that when we are buying, things will turn around and it will follow the trajectory of the big boys that's going up. So looking at this right here, the best spot to buy would obviously be areas like this. You buy here, things go up, you make your money as things continue to go, okay? How do we identify this spot? That's the question, okay? Because everyone can say, I buy the dip. This is called the dip. Which leads me to the second thing that Urban Forex is very big on, and that's support and resistance. Right, so let me draw a line here. As we go up, as we are trending, there is areas in the market where things starts to pause, right? It paused here before moving up, it paused here before moving up, and then it took a very long pause here before going up further. The longer the pause, the stronger that area becomes. The reason for that is because we have issues going up from here. Think of this like a road bump, right? This is a small road bump that you're crossing when you're driving, so you don't really remember it because it's small. It might just be a pebble that you just ran over. Another small pebble, but here, this is a big pothole maybe, right? So this is something that stops the market from going further. And when we actually do go further, it becomes a strong level. We have a full webinar on support and resistance, link in the description. You can check it out. But this is a very short, concise way of explaining what support and resistance mean. So let me draw out this level here. And the reason why I'm drawing that level out is because this hold is much longer than usual compared to this one and this one, okay? So the step-by-step process is like this. First, identify a trend, which we already have here, a trend, okay? It's going up. Second, identify the support and resistance around those areas. Where is the strong support and resistance? AKA the level. Okay, so this is a strong level that we have here. Now, the third phase, once you have identified those two things, you want to see if the market pulls back and then goes. All right, so before the going part here, we first want to understanding when does the market pull back and if it stops at the level you're watching. Okay, so let's look at this one step at a time. We went up all the way towards this area here, right? And then things start to move down. Now, the reason why we have our support and resistance here is because we want to see if things would slow down when we actually pull back to that area. As you see price coming back down to here, you see a reaction, you see a reaction, another reaction, right? And then eventually things starts to go further. As a trader, the better you are able to time when things are gonna fly, the better you are at risk management. Because think about situations like this. If all you're doing is just identifying a level and when price comes down and you just hit the buys, you're taking a lot of risk on your hands, right? Because what if things don't bounce? What if things just crash? What if you hit the buys and it just stalls like this sideways? Your trade is not moving. The longer your trade doesn't move, the riskier it becomes because it does not tell you that your trade is working. It does not tell you your strategy is working. So the fourth thing is identifying the right time to look for the buys. Okay? When we look at a trade like this, this is where timing comes into the market. Okay? So as we pull back, I want you to first understand this concept called fading momentum. What that actually means is we want to look at the move coming down and we want to see it slow down. This move here is fairly slow, but as we're coming into the level, it's getting very, very fast. We know it's fast because this candle moved down very quickly. It's a big candle going down as opposed to the ones before. It's very, very slow, okay? So the right strategy is making sure that as we're coming to the level, we're really slowing down, okay? Now, we came down very strong. That's fine. We just need to make sure our level, our support and resistance is holding. Here, you can see it's holding. It's not going any lower. It tries to go lower, but immediately got snapped back up. So look at this. Went down, another move down, no resolution towards the downside. It's just holding there, right? And then immediately you see a snap back up. This move is telling you your support and resistance, your level is holding. Now, the next thing here is gonna be a little bit more advanced. So if you're still watching this, make sure to hit the like and subscribe because this is where we're gonna go into the nitty-gritty stuff about timing and what things to consider. Now, check this out. So as you see things slow down here, sellers, in this case, the pullback, they're not coming down anymore, right? Things are just holding sideways here. This is the best area to look for your buy. Because now, after this strong move, it's just holding sideways. What you want to see is a rejection from the bottom of this small little range, which is areas like this, and then get in on the buys, okay? Now, some of you more experienced traders will look at this and be, how would we know to buy here and not buy here? What's the difference? The difference here, ladies and gentlemen, the time of day. Okay, so what's so important of time of day? There's three key time of day to consider when you are Forex trading. There's the Asia session, there is the London session, and then there is the New York session. Most of the time, things will slow down in the Asia session. Now, sessions can be a tricky subject, so what I really recommend is using market countdown, because market countdown actually tells you what time of day it is in the Forex market, what sessions are going to open, and what news are going to release. To answer the question, how do we know to buy here and not here? It's because of the time of day. If we look at this area here, this is 8:15 p.m. New York City time. Okay, again, 8:15 p.m. New York City time. That's where things tends to slow down. Around here, this is 12:45 a.m. New York City time. However, that's Asia session. Sydney is in full swing, Tokyo is in full swing, and around this time right here, that's where London is about to open. Okay, and as you can see, when London opens, things would go up. So these are the stuff you want to take into considerations when you are trading. Let's start off from the top again. The first thing you want to look for is a trend, which we have here. Second thing you want to look for is a strong level, support and resistance. Third thing you want to look for is to see price coming back down into your support resistance. Fourth thing you want to look for is to see things slow down and to see that your big boys are back. When you see your big boys are back, you want to see price holding. Holding meaning the big boys are holding their grounds and getting ready to launch. That's where you want to position yourself, because you want to ride the wave, not against the wave. And then the fifth thing is making sure that you are not trading at a time where the market is not active. That's where market countdown would come in really handy. Again, link in description. Make sure to get it on your mobile app. You have a 1-year free trial. It's the best app that they have produced. Okay, let's look at a few more examples, and hopefully things will start to make a lot more sense as we look at these examples. So let's first start looking for a trend. Look at the far left, look at the far right. Where are we in comparison? Are we going up or down? Here we're going up, right? So obviously we are in an uptrend. Okay, good. We're in an uptrend. Let's do the second step, which is marking out our support and resistance. Here we have a clear level to mark out our support and resistance. When I say level, remember the road bump analogy I was speaking about? See, when we are going up here, the amount of resistance we have before breaching up. The more resistance we have, the stronger it becomes. And where else have we seen this kind of resistance? We have seen that here. We have seen that here. So every time we see price rejecting like that, rejecting, but as soon as it breaches above, that tells you that can become a strong support and resistance area. Okay, good. So we have two things covered now. We have the trend and we have a strong support and resistance. The third thing is seeing price coming back down to that area. And it has to come down in a slow fashion way. This is where we are really fading the momentum. Okay, so let me show you how we generally do it at Urban Forex. We move down fast, right? We see some reaction from the buyers, which is our big boys. We see another move down here. Now look at this move down here. Is it stronger than this or is it weaker? Hopefully you have said weaker, because look at how much candles it's coming down, right? It took 1, 2, 3, 4, 5, 6,000 candles to come down. And here, look at how far this distance covered, but it just took 4 candles approximately, right? But here it took 6 candles and it traveled very little. So that's another hack that we actually use to fade momentum. If it's going down slow and it's taking a long time to go down, that tells you this pullback is slowing down, and it's slowing down at the right location, okay? This level is very important to us. We want to see things really turning around. And as you see, we came down to that area, we touched that zone, and we start bouncing off, right? Once you have seen that and you see that the sellers, in this case, this red bar coming down, is unable to move any further towards the downside, that's where you want to potentially look for a buy, okay? In this scenario, we don't get a range like we saw earlier. Guess why? If you're able to answer that, kudos to you. But if not, now that's because when we are looking at the way that it's coming down, it's slowing down, right? The previous one that we were looking at, the final move that it came down with, it was fast. So how fast the momentum is coming down and how slow it's coming down makes a huge difference. So let's look at another example here. Here we have the Aussie US dollar, okay? Australian dollar to the US dollar, right? So for this pair, where are we going? Are we going up or are we going down? Obviously, if we look at the far left and the far right, we are going up. We are in an uptrend. Okay, first thing is covered. We have a trend. We know the big boys are around. Second thing, identifying the level. Do we have a level to work with? Yes, we do, right? Before this move to the upside, we see a strong rejection, came back up, another rejection, and then only a breach to the upper side. So we have those two things, the trend and the level, okay? What's the third thing? The third thing would be making sure that we come back down to the level and then making sure that it's slow. Question here is, are we coming down slow or fast, right? Initially, we came down fast, but things sort of fizzle out. But these are not areas we want to buy because we always want to make sure, remember this analogy that I had earlier? You want to make sure you're buying at an area where things will turn. And the best area where things will turn around at is support and resistance area. So because there's no support and resistance here, these are not areas you want to be thinking of buying, okay? When we come down here, now that's where you want to get interested. However, there's a conundrum here. The way we went down is very fast. It's not strong. So it really depends on what happens next. Here, you would see as soon as we touch that area, things turn around very quickly, okay? Now, don't get me wrong, it didn't go up fast, but we touched and we go. This just tells you there is big boys around at this area. Remember the first example we looked at where the last final move was strong? What do you want to expect next? To see things start to range. When you see that price is ranging here, like this, that tells you the bigger boys, they're looking at this market and they're holding their grounds. And if you're able to catch the bottom of the range, that's where your buy would begin, okay? So as you can see here, we slowly moved up further. So those are, in my experience, the easiest way to approach the markets. Basically just looking for trending markets, looking for strong support and resistance, looking for the pullback into the strong support resistance and fading out the momentum at the support and resistance level. We cover this in depth in Urban Forex. This is something that I have personally used for myself, for my personal trading, for my investment portfolio, and it has worked wonders. Trust me, you don't need to look too far for a good strategy. You can use basic techniques like this, high return on a monthly or yearly basis. Now, what I want you to do is take this approach and test it out in the markets. Because chances are this is the first time you've seen me, and I don't want you to take any of my words for granted. I want you to take this approach and test it out on the markets. And make sure to test it out on a demo account so you're not actually putting real money on the line here. Making money would come after you have a good track record from your demo account, which we'll get into right after this. But I want you to first take what I have just taught you and test it out in the markets. As you're testing this out, I would really recommend you picking up the courses at Urban Forex because it definitely would fast track your record. It has a 30-day money-back guarantee, so if you don't like the courses in the first 30 days, you can always ask for a refund. So now let's move on to the fourth section, which is treating it like a business. You would be surprised that there are a lot of traders, despite the years of being in the market, they're not actually tracking the way they're trading. You want to think of it like this. Again, let's go back to the analogy of running a restaurant, let's say. If you're running a restaurant, day in and day out, you're not knowing how many customers that's coming in. You're not knowing how much those customers are paying for. You don't know how much cost you have overhead for your employees, for the ingredients, for the bills for electric and water supply. If you don't know the cost, you don't know how much you're making, if you're not tracking any of those, you are unable to improve. In the restaurant industry, it could just be adding 2 more tables to your restaurants and you would be extra more profitable just because you know on a daily basis how much seats are being filled from 7 p.m. to 10 p.m. The time where people would come in for their dinner, if you maximize on that, you would make a little bit more money. And the only way you will know that is because you're tracking your business, all right? So the same thing applies to trading. You want to make sure that you are able to see what you're doing well, what you're not doing well, and based on that, you will have a better understanding of where you will end up in 5 to 10 years down the line. Okay, let's not think about 5 to 10 years down the line. Let's just first make sure we set the expectations right and we know what we need to keep track of. So let me show you some examples. So what I have here is a sample of a spreadsheet from a student of mine. So what this student has put in is a $10,000 account, and then here you will see all the details for that single trade. You can pause this video here and just take a snapshot and then just recreate it for yourself. But what I really want to highlight here is there's a few things you want to take note of, okay, which is going to be very important later on. So the first things first, obviously we will put down the currency you're trading, you're selling or you're buying. Did you make a profit or did you make a loss? Okay. How did you close out the trade? Did you close out the trade because it hit your take profit, or did you just close it out because you see that things are not doing well, right? So in this close method, this student has put manual instead of take profit. Okay. Pips, how much pips did you make from the trade, or how much pips did you lose from the trade? Okay. And then this is the profit, right? From your demo account, from your brokerage account, how much money did you make? And then this is the cumulative account balance. For gains, it would be how many percent did you make off that one single trade. For this student, he's risking 1% for every single trade. So you can see this trade here, you made 1.41%, 1.28%, 2%, so on and so forth, right? So this is the date, the price that you open at, the date that you close the trade, and the price that you close the trade, okay? What is the stop loss that was in place, and how many pips away is the stop loss from your entry? This is the part where it's important because that's what's gonna determine your risk to reward. Now, stop loss, let's say if you get in on a trade, let me show you again. If you remember the trade that we were taking earlier just now, we were looking for the buy here. We took the buy around here. Our stop loss was here. Our take profit was around here. I think it was somewhere around that. Okay, we don't need to go into the details right now. But if we measure this to the bottom, that's 7.2 pips for our stop loss, around 7.8, something around there. And to the take profit, it's around right here, right? 7.5. So we're risking 7 pips, more or less, to make 7 pips. So that's what we say 1R trade, okay? Risk to reward. It's a 1R trade. This is what traders usually call this, okay? So if we go back to this spreadsheet here of this student, you will see that on average, okay, on average, his trade is 0.75. Is that good? It's healthy. But is it good? It's not really good. Ideally, you want to have trades more than one, okay? Overall, your trades should be more than one. So these are the stuff where it's really, really important to track. This one here being super important. How much risk reward does your trade generally generate? That's number one. That's one of the most important thing. Now, second thing to consider is overall, what's your win rate? Okay, when traders are talking about win rate, you want to understand when you're taking a trade, what's the winning percentage that you generally have? So For this student's spreadsheet, for example, there's 11 trades and there's one losing trade. So we can estimate that this student's win rate is around 90%, right? But 90% is a very, very high number. I do not expect everyone to have a 90% win rate. This is a number where you want to track over 30, 50 trades, all right? Once you get to 30 to 50 trades, then you can see with a big sample size what's your win rate and what's your average risk to reward for every winning trade, okay? Those are the two metrics that you really want to understand and keep in mind and track, because only by understanding that you can tweak your strategy to improve to get to the next level, okay? So I want to show you something very cool here. Once you have around 30, 40, 50 trades, you get your numbers, you understand your metrics around your trading, here's something fun you can do, all right? So this is where we come back to the expectations, knowing what to expect, right? So you cannot really know what to expect until you have a number to work with, all right? So with the strategy that I have taught you, try it out for 30, 40, 50 trades on a demo account, see what the result is, and then play with this a little bit, okay? So for example, start with equity, right? This is basically how much money you're gonna start off on your trading account. So let's just say 10,000, okay? What's your winning probability? And that's what I was talking about earlier. It can be 50%, it can be 40%, that's still fine. But you wanna make sure that your risk to reward is healthy. So earlier I was saying a good risk to reward needs to be at least 1. Ideally, it needs to be 2, 3, so on and so forth. But let's just say 2 to 1, okay? And this is number of trades. Let's put in 100 trades, number of lines. I'm gonna explain what all of this is in a bit. Let's just put 50. And how much risk are you risking per trade, okay? Let's just say 2%, okay? Start simulation. Now, this is a simulation, right? So I'm saying that we are starting with a $10,000 account from the spreadsheet. Let's say that we know Kelly has a 50% win rate and her win-loss ratio generally around 2 to 1 for those winning trades. And we are simulating 100 trades, and these are the different variations. So what this means is after 100 trades, this is generally where she would end up, okay? Starting with a $10,000 account, after 100 trade, we are looking at around 26,000 from 10,000, right? That's more than 100% gain. So this is something fun you can play with, but you will only know what number to put in here once you have your spreadsheet laid out with all the details, okay? So the system is like this. Take the strategy, go to a demo account, try it out for 30, 50 trades. Once you get a good number, solid number, put it on a simulation just to see if you start committing capital, then you can understand what's a closer expectation to look at, okay? Of course, to speed things up, I really recommend you checking out the courses at urbanforex.com. They have wonderful courses which will get you profitable very quickly. So it's important to remember when you are first starting off, your goal is not to make a lot of money. Your goal is to first start off understanding the right strategy, apply it. When you see that you are able to have those good numbers that I just showed you, that's where you can start scaling up. And by scaling up in traders' world, it just means injecting more capital into your account and then slowly build your wealth. So there you have it, the complete guide from getting you from point A to point Z, starting from a complete beginner to a professional, profitable trader. You want to make sure you follow each step along the way here, and also make sure to come back to this video every couple of weeks just to make sure you're on the right track. And also, if you do have a friend that's also getting into trading, I really suggest sending this to them, because this is really gonna be helpful, and it's always best to have a peer to trade along with. And if you really want to speed up the process, I really suggest picking up the MPA 2.0 from urbanforex.com. I've personally used the techniques there for my trading, for my investment portfolio, and it has worked wonders. So if you really do want to 10x your speed getting from point A to point Z, being a consistently profitable trader fast, that's something I really recommend picking up. Again, link in the description. Also, if you like this video, make sure to hit the like button, subscribe, turn on the notification bell so that you will get notified when more of these videos come your way. I'll see you on the next one. Cheers. Bye for now.